Thank you all for coming today. I apologize, I did a presentation not too long ago and I was mic'd up, so I just had this intention today of walking around the stage. So if I start doing that and you can't hear me, which is very unlikely, say something. But I'm realizing I'm not mic'd up. I want to get moving today. So thank you all for coming so much. It's great to have everyone here. Sunny day. You're going to hear a lot of positivity today. I think we've been to enough of these hearing about negative things in the market and feeling very bullish about what's going on. I do want to start by thanking Cassie. Where are you, Cassie? Put your hand up. She's probably working, doing something. She sets all of this up so expertly that some people changed last night and so huge round of applause for her and the rest of the team.
Thank you.
Agenda today, rent vacancy, talk about what's going on. Today we're going to flip-flop, or we're going to have a broker panel after this, and we're giving more time to that broker panel. So when the slide materials come out that get delivered to you, there's going to be more slides. So for the insomniacs out there, you can review those slides, but it's going to be a bit abbreviated today. So rent vacancy is going to be a little bit truncated today in certain markets. Development pipeline, talk about what's going on in development, talk about what's happening in the sales market, and finally a forecast. I'll give you a near-term, long-term of what I see happening in the market, and then from that we're going to have a broker panel hosted by Jerrid today, talking about various markets across the Northwest. What I'd like to start with here is really like an operational, like what we're seeing with apartment operations throughout the region. And what this is supposed to represent is someone at the switchboard with way too many buttons. I would say the last couple of years, everyone was kind of hitting the panic button, meaning rents aren't going up, expenses are going up, is this thing on, how are things working? What this is meant to represent is we're really trying to dial in operations right now. We're starting to see rent growth in certain markets, and we'll see some slides across the board. We've seen rents go up in almost every single market in the region. Expenses are still high as a proportion to income, but we're starting to be able to control what's going on. We're starting to push down some concessions in certain markets. So I really think operators are having a little bit better time than they've had in the last couple of years. Things aren't off to the races quite yet. But if you're starting to feel like you can begin to push rents and see some light at the end of the tunnel, then you're like others. If you're not, then you're probably in a market with a ton of new supply, or you're just doing something wrong. Next, turning to capital markets, what I'm calling this is launch sequence. The rocket hasn't taken off yet, but we're definitely seeing positive signs of liquidity in the capital markets. What does that mean to the layperson? Deals are getting done. Now, it's not that they're getting done in such force that you see a new sale that's peak pricing at the top of the Puget Sound Business Journal every single day, but transaction volume is picking up. And it's doing so somewhat in a fashion that people aren't paying attention to as much as they might otherwise, but it's mounting. And we're starting to see that in the capital market, which means it's going to start to spread. We found price discovery, and I feel very optimistic that we're going to see prices continue to rise and not kind of bounce along the bottom, which we've seen really the last 30, 36 months. Now, turning to rent vacancy, what we're seeing across the markets, this first slide is about the entire region. And so what we're looking at the top of the slide is rents about a year ago, a little over $2,000. 90 days ago, they crept up a little bit, and now we're seeing positive momentum. Almost every year I saw rockiness in the slide where in the last 12 months, rents went up a little bit, they went down a little bit. We're starting to see some momentum of trajectory in rents across the region. Now we're counterbalancing this with vacancy. Now I say this every year, this is gross vacancy. We don't get great data on bifurcating stabilizing buildings and stabilized buildings. And what does that mean? There's noise in the vacancy numbers. And there's usually about 50 basis points to a full point, meaning the overall market might be at 6% vacancy, but we're showing 7 because we have so many new developments in the market right now. Now that number spiked over the summer and it's come down. So if we're growing rents and we're growing occupancy, that's where we want to be. And we're doing it across the region. So we're seeing some positive momentum in that space just across the region of starting to build NOI with our properties. Now turning next to King County, looking at a year ago to today, we've seen rents go up, we've seen vacancy go up as well. Not surprising, King County's had the most deliveries. Q4 2024 was peak deliveries, but that doesn't mean we've gone off a cliff. I think a lot of people thought once we have peak deliveries, there's no more. Well, the reality is, and I know we have a lot of developers in the room, nothing goes as planned. And every development takes a little bit longer to get across the finish line. Now, the fire marshal is showing up, you're getting your elevators, things are happening faster than they were 2 years ago, but it's still taking a little bit longer to deliver, and that's why we're still seeing a bit of a spike in vacancy rates in King County. Turning to Snohomish County, good news in Snohomish County, rents are picking up. Snohomish County's been pretty strong throughout all of post-pandemic, but they're still seeing a little bit of moderation. Vacancy rates went down just a tick, not a lot, but they're still trying to find equilibrium. And most of that is from owners pushing rents, responding to in-migration coming up from Seattle and King County into Snohomish, and they're really trying to find that equilibrium. Turning to Pierce County really has started to recover. You know, what happened in Pierce County is a ton of new supply in Tacoma, and they had to absorb that new supply, and we saw a big lift in rents. It's done well, but there's been legislation, Measure 1, there's been challenges down there for landlords to operate. The post-COVID operations went really strongly, and then it took a little bit for them to pick back up. And so that's why we saw vacancy spike and now starting to come down. Turning to Kitsap County, I'd say Kitsap County's been the biggest swing. It's a much smaller market in Kitsap, but it did really well post-pandemic. A lot of people moved out to Kitsap County. We saw rents skyrocket. We were seeing some growth, 10+% year over year, with vacancy rates really far down. Between that and QOZ, qualified opportunity zones, in places like Bremerton, a lot of new development picked up, and we saw a spike. So we were seeing 11, 12, 13% vacancy rates. Most all of that was new construction. So Kitsap we saw good rent growth, and we saw vacancy decline. So Kitsap's definitely having a recovery. Most of that's based upon new supply in Kitsap County. It's been a very strong market, but also as people re-migrate into King County with jobs requiring there's less work from home, Kitsap has suffered a little bit from that. Now, looking at our markets, market by market, in the past I've looked at Seattle, just all the supply in Seattle, what's happened to rents and vacancy. I switched up a little bit for slides this year of product built before 2000 and after 2000, because they really have been operating differently. And new product has been fighting against itself. That's trickled down a little bit to some of the older product, but we really have seen some trends bifurcate between brand new buildings and some of the older cohort. And if you look what happened, this is buildings built before 2000, no big surprise. Rental rates dropped off during COVID. They picked back up. There's a pretty sharp uplift in some of the older buildings, and then it moderated. But what has been really fascinating the last 12 to 24 months is rents have really picked up in some of these older buildings. And part of that is they were mispriced. Some of these landlords that own smaller older buildings didn't respond to the market as quickly as more institutional owners. But I hear a lot of people moaning and groaning, we haven't had rent growth. Well, the data shows we have had strong rent growth, we just have a lot of new supply. And we look at this and looking at the vacancy rates, you see a spike in vacancy during COVID, it moderates, and this product has not competed dollar for dollar with new supply, so the vacancy rates haven't shot up, and in fact, you look in the last 12 months, we've seen a good amount of rent growth and a moderation in vacancy, which shows me that this product is poised for some growth. Now, turning to the newer construction, pretty similarly, you can see here rents dropped off, they picked back up, and now they continue to rise. Now, the rise isn't as sharp as the older product, but the price point's, again, higher. What's different here is the amount of vacancy. We saw a big spike in vacancy. Now, part of this is a lot of new supply delivered even during COVID, right? As COVID was happening, we hit this market about mid-March, we were still delivering product. And then vacancy shot back down, is moderated. This scale still shows somewhere between 6 and 8%. But what it's showing is in Seattle's urban markets, we are poised for a recovery. Rents are up, vacancy is down. And that means there's room for landlords to begin pushing rents. And I know as early as February, March, I was talking to landlords, that on renewals they were at 2 or 3% versus flat. And last year was flat year over year on renewals. So we're starting to see some recovery in Seattle, but it's kind of below the radar. And I think for those of you who are looking to acquire or develop, if you're following the national data providers, are probably going to lead you in the wrong direction. Now, switching over, looking at the new development, this slide is what really is instrumental in showing what we've done that I think has been really productive. If you look at last year, nearly 7,000 units were delivered. If you look at the pipeline of what's under construction, that's less than a year of delivery. In a normal year, we've delivered about 4,000 to 5,000 in the urban markets. So this supply is going to dry up. It didn't happen as soon as we thought. And this slide will scare a lot of people, but the developers in the room realize that getting this 17,000 units capitalized is very difficult. So we have a lot of product that could get built, probably isn't going to get built in the near term. Now switching over to the east side's been a sweetheart market. If you look at East King, they had a little bit of drop off in the older product, and it has steadily gone up quarter over quarter. It's been a little bit more muted, but bulk rents are still pretty high. This is an older product on the east side. And you look at vacancy rates, they shot up a little bit and they've moderated. So the east side's done a really good job of handling new supply in this older product. Rents haven't really shot up, but they've maintained. Now looking at the new product, we've had a really sharp incline in the new product. And the next slide will really tell us some numbers of how much young urban renters have left Seattle and gone over to the east side markets because it was more livable. I'd say it's more, I wouldn't say affordable than Seattle, but the combination of livability and lifestyle allowed or really pushed renters to pay more in rent just for the ability to live somewhere they wanted to wake up versus being in these Seattle markets. And you look at what's happened, it's really telling. Occupancy really shot up. This is showing vacancy decline post-COVID. We filled a lot of these buildings. Developers responded, and they built a lot of buildings. And so everything that got permitted and capitalized in 21, 22 got built. And all of that got delivered in 23, 24, and now 25. And now the east side's really looking at trying to harmonize rent and vacancy. And as you see here on the slide, we've delivered quite a few units on the east side. And that supply is dropping off now. So I think what we're seeing in the market is there are opportunities emerging for development. I'll talk about that in a second. But we've really got through the spate of new supply, this flood of new supply that's come on. We've got a fairly limited amount that's being delivered right now. Yeah, there's a ton of units on the other side of this that could get built. They're probably not going to get capitalized in the next 6 months. But I think on the east side, in the nenext 6 to 12 months, we're going to see a lot more projects breaking ground. And the moral of that story we'll talk about in a bit is we're on to the next development cycle. Now this is really telling. This is a slide I've shown before. I bifurcated this to build 2,000 and newer because I think that product's competing more with itself. But if you look at this, is just end of year 2019, CoStar rents in the Seattle urban neighborhoods just a tick over $2,200. You look at east side, just a tick over $2,300. So call it a $130 difference between that, so maybe 4 or 5% differential. Fast forward 6.5 years, Q2, this is Q3 data from the middle of Q2, the middle of 25, Seattle rents have gone up. They've actually moved up. But if you look at how much east side rents have moved up, if you look at Seattle, the cumulative total is about 9%, and the east side it's 20%. So more than double. This slide last year, east side rents had moved up about 23%, in Seattle about 6%. So what you're seeing in there is Seattle's starting to catch up. Its rents are starting to increase relative to the east side, but there's still a huge opportunity. What I called this last year is there's an ability to pay 10 to 12% higher rents in Seattle, but not a willingness to pay. And I think that willingness to pay is going to start to shift as livability, return to work, all of those dynamics shift in the next several months. Now, I have slides for every other market, and I will deliver those to you when we give this presentation. We just didn't have enough time to cover every other county. And in that, we're going to cover Eastern Washington as well. So this is a highlight of that data, but the slide deck will have those individual slides. Now, this is an older product, rents, this is the last 6 years. How much have rents moved cumulatively the last 6 years? So older product in Seattle, 8%, newer product, almost 10%. This is cumulative in the last 6 years. You look at the east side, 25%. That's older product, 90s or 2000s and older. New product, 20%. Now, not as much because it's competing with itself, so there's some concessions baked in there. You look up North King, 14%. Snohomish, 23. So it's no surprise that the dollars, investors are going out to these other markets because they've seen the rent growth in these markets. Now, I look at this data and I look at, there's a huge reversionary story here. Is this trend going to continue like we all think it will? Generally, they revert back to the mean. You look at Kitsap, really strong growth, but as you've seen, it's starting to moderate. You look at Spokane, 22%. And I would not have guessed the winner in cumulative rent growth in the last 6 years. Tri-Cities. It was surprising to me, but it's not too surprising if you look at the lower rental rates in these markets and a huge amount of influx of renters moving out of these markets. I'm starting to see in the slide show that Tri-City rents are starting to decline. Spokane rents have already declined. And so I think there's an opportunity in these urban markets, we're going to see some rent growth. But we're just not seeing it in the data providers and we're not seeing it yet in the market. Turning to key takeaways, what I'm seeing in the market is this is the first time I've given this presentation, probably in 4 years, where there's been rent growth in every single market. So what that's showing is it's steadily turning into a landlord's market. Because other markets, it was going up and down, and there was some competition for renters. Next, vacancy rates were past the peak. Concessions, like I mentioned earlier, we are fighting concessions in certain markets, and that's challenging, but that will bleed off. And then finally, impact from work from home, that really is happening. Last year, I said it's starting to happen. This year, yep, it's really happening. We are seeing that return to work. We saw it in the downtown urban markets as soon as early January this year. Turning to the development pipeline, this is our region. There's about 400,000 units in the region. Just a little over 100,000 were developed during our last cycle. We've got about 145,000 as a pipeline. If you look at how this is broken down, 90,000 in permitting, 38,000 actually have permits in hand, and 17,000 units under construction. Oh my God, so many units. Well, on the stage last year, that was 28,000 units under construction. So we've absorbed a huge quantum of units. On this stage previous year, 39,000 units under construction 2 years ago when I was up here. So we have done I think a tremendous job regionally delivering over 20,000 units to the region in the last 2 years, and we've seen rents cumulatively grow. So there may be a lot of bad news in the market, but I'm looking for you to see through those headlines and realize that we've got really good firm footing for the next development pipeline. Here's some concentration. Those of you with insomnia or want deep data, this is our development report. It's on our website, 80 pages or so that all look like this. So if you want to look granularly at every market and what's happening, we have that report out there, and I encourage you to look at it. I don't want to go through all those slides, but we can see there's a lot of development going on in the urban core, not much in the other markets. What I did want to talk about is a little bit of concentration of supply. So this is in the Belltown market. You can see a huge cluster of supply, about 100% of inventory. A decent amount's getting delivered. I do like these markets. I think the waterfront story is great, but it's going to take some time. These markets are going to suffer a little bit in the near term. So you look at the east side, Bell Road corridor, same type of story. We talked about the east side is looking at these clusters. We've seen a huge amount of deliveries in Redmond, Overlake, and that's pushing into Bell Red and Bellevue. So you've got to really pay attention to the dynamics, not in just your granular market, but the markets around you. Over 100% of supply that could get delivered, not all of it will. Now, turning to a market that normally was a sweetheart market, Capitol Hill. Anyone remember Chop Chaz? Things on fire, people very nervous. Well, if you look at this, 130 units are being delivered. My eyesight's gone, 139. I don't see Jonathan here, that's his project. There's one project in all of Capitol Hill. There's some small projects, but there's not that much being delivered. I looked back at this data pre-COVID, so this is the presentation 2020 before COVID had hit, there was 1,000 units being delivered or being under construction in Capitol Hill. Most people are concerned about that market. Light rail is opening soon. Salt and Straw is still gouging me $9 for a scoop of vegan ice cream. People are up in that market and developers are not in that market. These are the opportunities I think are in the marketplace right now. They're right beneath the surface that people don't see, but I think are great opportunities to look at where the market's going to be in the next 2 or 3 years. Now, why haven't they been developing? So this slide's been changing around a lot. In the left-hand column is the cost to build. Frank's here, he's going to keep me honest on construction numbers. I'd say development cost on the low end, this is podium, about $400,000 a unit. Some might be able to squeeze in a little bit below. On the high end is $500,000 a unit. I'm definitely seeing it $550,000, but I think $400 to $500 a unit is a barbell. But if you look at the terminal pricing, it used to be high 2s, low 3s. Now we're seeing sales pricing. We just had our first closing of non-high-rise type 1 construction over $500,000 a unit over on Capitol Hill, Liza. So we used to be looking at selling podium construction in the 3s, then it was the 4s, now it's the 5s. So we're seeing that progression, that flight path coming out where new construction makes sense. So some takeaways, we're past the peak. Developers are really focused, they were focused on suburban, they're coming urban again. The east side has been favored, that's going to be the nearest term deliveries. And I think 2025 is the mark of the next cycle. Like I said, all this research is available on the website. Last is sales trends, looking at the sales market. I'll have more slides up here and what we send out to you, but I did have to truncate them a bit. Looking here, this is sales volume. So the red line is number of transactions. The blue lines are total volume. We did have a good peak in 2016. That was kind of like the big last cycle peak. We had another peak in 19 due to the excise change, and then post-COVID. But if you look at where we are now, that might not seem like a lot year to date, 2.2 billion, 130 sales, but this is the data from last year at this time, 1 billion. So sales volume up in the last 12 months, 100%. And that's what I'm talking about, is we're finding a footing with sales, we're finding equilibrium between buyers and sellers and price discovery. And that's happening real time in front of us. And I think it's a little bit sleepy, but this is the makings of the next cycle. Looking at values, red line's cap rate, you can see that it dipped in 21, 22 when interest rates were really low. The blue lines are price per square foot. I like that a little bit better than price per unit, because how big is a unit these days? We're at about a 5.5 cap, 5.4 regionally, about 326 in net rentable. You look at last year, about the same. So when we're staying about the same place year over year, that means we're poised to go and reverse this trend. So we're at this peak. You can see the sort of shape of the wing curve here. I do think cap rates are going to start to fall and prices are going to start to surge. This is CoStar data. This is their predictions. Take it what you will. This is the curve. This is my slide from last year. Yeah, like we called out, you can look at what was happening in 21, 22. We're hitting a peak in cap rates, and this is their forecast. Everything's rosy. We're going back to 3 caps. Well, I didn't really believe the slide then. I don't believe it now. It turns out they don't believe themselves now either. What they're showing is a little bit more moderation, that we're probably going back to a 4.5 cap market. So we are going to have, we will see some reversion to those lower cap rates, but I don't think we're going to get back to that pricing we saw in 21, 22 until we see NOI growth. It was not going to happen from cap rate. So it's kind of that moderate, like, yeah, it's time to get back to work. We're not those people waiting for those distressed sales and not really going to happen. Those sellers waiting for pricing to really rebound, probably not going to happen. We're going to pick back up nicely and have a smooth transition back to higher pricing. Some key takeaways on the sales. Volume increased by 100% year over year. That's good news. That's price discovery. Prices will come up from there. Second is we're off the bottom, and so we're going to start to see values in mass rise. It's not a reversion to where we were, it's more of a reset. We're resetting expectations of the market. We're not reverting back to those peak prices, but we are picking back up. And then finally, the darling markets. What investors are looking for, they want resilience. The best neighborhoods, the best product, and that's where we're seeing the lowest cap rates. We definitely see the widest pricing in far-flung areas, areas with high delinquency rates, older product. Some forecast, I'm going to look at the near-term forecast, what we're seeing. Number one, rental rates. We're starting to see a landlord's market. It may not feel like it as a landlord because we all forget what it's like to have fun in this business and see real growth, but we're heading in that direction right now. Next is occupancy. Like I talked about, I think we've hit our peak in vacancy rates, and we're going to start to climb back with higher occupancy, which means we're going to be able to push rental rates. Next is development. It's back. I like selling development land. Jerrid will show some slides. It used to be about half of what I did. It came up in the last 3 years to be zero of what I do. Now it's probably about 20%. So development sites are making sense again. And finally, distress. I think the distressed deals are tough. And I think they're the same deals that have been distressed. And I think it's going to feel really difficult buying them because they're distressed. They're not going to be sweetheart, darling deals probably for another 3 or 4 years when you take that risk now. I think everything else, buyers are aware of where pricing is. Long-term forecast, a lot of this looks like my presentation last year. In fact, I didn't change the slide up much because I have conviction that we are a darling market, and I think we're getting back to that darling status. When I'm in markets like San Francisco, LA, I hear investors, especially on the capital side, their capital sources, endowments, investment funds, they want to be in the Northwest. They see the value of being in this market. And I'm starting to hear that across the nation of we are a top prospect to be in, and we haven't heard that in a long time. Next, rental rates. I think we're going to hit a new peak. Last year, I'll be honest, if you look at my slides, I said rivaling San Francisco. San Francisco's back. That's a very good thing for us, but San Francisco is rocketing out of the downturn. Occupancy in their offices picking back, AI jobs are picking back, urban rental rates are picking back. That's a good thing for us, so we're still a discount play. It's going to take probably 18 to 24 months for that to translate into this market. But if there is a good bellwether of what's going to happen here, it's in the Bay Area, and they're picking back up. So I muted this a little bit that we're gonna trail San Francisco. We're not going to compete with them, but that's a good thing. Abundance of capital. I do think sales prices are going to tick back up. Capital is coming back into the market. It's going to take some time to translate because we're not going to have these really, really low cap rates. We're going to need NOI growth to get there. And then finally, the political landscape. East Side's shown a lot of foresight. I'm sure Kevin will enjoy seeing this slide. Seattle's trying to get there. We'll see what happens with this mayoral race, but we're coming back, and I think the urban markets are looking good. I think the region as a whole is going to remain really strong. I'm going to switch over now and take a couple-minute intermission as we switch over to the broker panel, but want to thank everyone for their time and attention being here for the slides. I really enjoyed doing this and getting a chance to speak with all of you. Thanks so much.
Bryce, you didn't have his.
He was wearing a lot of rose-colored glasses. So Keith, what do you think of? What do you think? What he said? What do you think?
You buy it?
I'm a buyer. Absolutely.
I think there's a lot of stuff at the high end of selling. And then
I'm just not seeing it. I'm not seeing it.
you're all looking for 6
Our soon-to-be neighbor here making out of you. I'm in the building.
Take a journey out the deals that we've underwritten in the past 4 to 6 months.
Yeah.
We're going to pull all of those Excel models and the cap rates we were selling
I went in there
to
for the first
those.
time a few weeks ago.
Pretty start the compression. I mean, we were underwriting
You actually get into it. It's like they got all this retail space.
and we're saying that
It's like
it depends on the product. So we've seen 50, 60 hits in one direction this year.
I'm like, I gotta figure out what's going on. So I did a little thing. Development guy. He got in charge of my security.
dive back in. While Bill was speaking, they dropped off some fresh steak, and we all ate it. So this part of the discussion, I'll introduce you to some of our team members, and we'll go on a deeper dive through what we're seeing year to date in the sales market. So this might be less data than we'll see from the CoStar, but more boots on the ground that we're seeing on actual sales, some which are under contract, some closed, some coming soon. So first off, introducing the panelists, we have Dylan, who you just saw speak, and he covers our 50 to 250 units, mostly throughout the Puget Sound. We've also closed as far east as Tri-Cities, South Vancouver, North Everett. No Canada yet?
Canada yet.
Okay.
Terrorists.
And Matt Johnston, who recently joined us but has been in the industry for 7 years, is focusing in Seattle, and that's on 10 to 100 units, so private client, and a little bit of almost institutional. Elijah, who's not here today, as you might see, just had a baby. They had to have it early because he's about the size of JD already. So JD's filling in. And JD also works with Dylan, and they have several deals on the south end right now. So a lot of good content to share there. And then lastly, Max covers all of Eastern Washington. So everyone else on the team fights over 4 counties. Max gets the rest of the state. It's pretty great for him. And then just doing a deeper dive, a lot of people here know our team. We're intentionally structured geographically to better serve our clients. And so you can see myself, Dylan, and JD handle some of the bigger sales, while Matt Laird, Matt Johnston, Jack Shephard, and I sell the private client deals in Seattle specifically. And then Elijah and Tony are focused on sales in Pierce County, Kitsap, and Thurston. And then Max works so dang hard, we put 2 of them up there because he covers a lot of counties. So, quick question for you, Max. What do you think and I guess for Max, Elijah and Tony live in Lakewood and Gig Harbor, so they live in that market, know it really well, born and raised there. And Max grew up in Yakima, went to this great school called Washington State University, and now lives in Seattle, but works a few days a week in Eastern Washington. So, Max, what do you think one of the benefits to your clients is having so much time in the other side of the state?
Yeah, I would say that the benefit for our clients is I know that area, born and raised there, specializes there, don't do anything in Seattle, but I still get the benefits of working with these guys. So you really get to know who the buyers are on this side of the state, who a lot of times are those aggressive buyers, through these guys and all their sales. They do more sales than anyone, and we're going to bring them over to Eastern Washington.
Actually reminds me of a story. I toured Max through a building. It was a 100-year-old building in Queen Anne, average unit size about 400 square feet, so the old studios. And we walked in, he's like, people live here? Where do they park? So this next slide is the only one I'll speak on, and then we'll start the panel. So this is the 10-year sales trends broken out by the markets which each person specializes in. The reason I changed Dylan's to just King County, even though he covers the Puget Sound, is like Dylan said, and I fully agree with, we believe that the core markets are going to lead the recovery and already are. And so if we look back at the price per unit, time cures all wounds in real estate. Lowest pricing was 10 years ago. But you can see that the urban markets, so Seattle peaked in 2019, and then the further from the core you are, so Pierce and Eastern Washington, peaked in 2023. So I think that was some interesting data that Seattle's well on their way through this recovery, while some other markets might still be descending or flat. The other thing I wanted to highlight were cap rates, which were interesting. You see the cap rates of 2021 and 22, incredible. 3.9, 4.0, 4.6 cap in Pierce County. We never thought we'd see that. And largely driven by interest rates. And I think some of our clients, especially sellers, I guess the reason they're red is it's from a buyer's perspective, not a seller. Sorry about that. The reason they're red, they're so low, but if you look at the average, 4.7 cap in Seattle, historically is an incredible cap rate. So we're just now seeing some newer product actually closing in the 4% range, as low as one of the sales that just recently happened, 4.5%. So it's possible, right? That's a premier product, brand new, so we're seeing a really strong recovery. So all this to say, we're in these urban markets, we're in the suburban markets, and we're seeing a lumpy recovery depending on where you're at. So, turning the panel, whoever wants to jump in first, curious who right now is selling and why are they selling?
Yeah, I'll jump in. So a lot of the people that are selling right now are, maybe they bought in 2015, they did really well in the property. They were thinking about selling when at the peak pricing, 2021, 22, 23. Can't get that pricing anymore and called me and said, Max, I'm gonna wait a couple years, pricing is gonna come back. And it just hasn't come back yet. And so we had one client, for example, during the peak, we brought him an offer at $130,000 a unit for his property in Spokane. Decided not to sell. He hired us earlier this year with the same buyer, same property, under contract about to close around $85,000 a unit. So he just realized that pricing is still recovering in Eastern Washington. Dylan mentioned we're about 2 years behind San Francisco and Seattle. Eastern Washington is probably 2 or 3 years behind Seattle. So it's just gonna be a slow burn there. So the people selling are the ones realizing that it's gonna be a slow roll, and if you have something you're excited to do with your money now, then, find that buyer that's excited and work with them.
Okay. Anyone familiar with the buying process? We're now having call for offers again, which is really fun. You get everyone against each other, have some competition. JD's been running a bunch of them. Who's buying? Who's showing up right now?
Right now, I'd say, specifically talking about Pierce County, it's people that are chasing yield. I mean, if you look at the cap rate, 6.5 for 2025, the highest it's been since 2016. So people are going out chasing yield. I would say for other markets right now, it's people who see good basis. They're from Seattle, they know Seattle. They haven't seen, deals closing at a per dorm price like this since 2017, 2018, and they realize there's an opportunity right now and it's not gonna last.
Matt, shifting to the urban market, who's selling and why are they selling?
Yeah, I would say on the private capital team in Seattle, two major themes that we're seeing are owners that maybe don't have enough units to really support great management scale, and the last several years obviously have been challenging on the operational front. So a lot of operational and management fatigue that are causing them to think about a sale. And then also sellers that are looking at recycling capital from deals that maybe they're just not excited about owning anymore. They've owned, for several years now and want to shift gears towards more core locations, newer assets, or size up into something that better supports management.
Excellent. We'll jump into some specific deals. So, not every deal or property gets sold, but a lot do. So, I wanted each broker to be able to highlight a win and what went well, and a loss or a challenge and what we could have done differently. So Dylan, first up, you have a $23 million sale, built in the 60s, and value add.
Yeah, I'd say with this particular sale, I think what this highlights versus the next one that didn't transact was it was a buyer getting yield. I think what's been really difficult is getting buyers to believe in the future. Generally, buyers expect they're going to pay for what's happening in the property today. In this particular property, operations were strong, trade outs were strong, it was full, and it was financeable. So someone could step in day one, get good yield, older product, but they could control deferred maintenance based upon how the building was kept, and they had a predictable yield going forward. They weren't asked to project forward. We always like to push people where it's going to land. Value add's been tough, because it's hard to justify putting $15,000 to $25,000 a unit and getting that additional rent pop. So this property was getting good trade outs, and there was yield.
Yeah, we've experienced that. A lot of sellers that have older buildings with a lot of deferred maintenance are having challenges keeping up with the needs of the buildings, and if they're not operating well, those are the ones that you see are pretty severely discounted. However, if you're able to offer yield, as Dylan mentioned, so cash flow day one, there's a stronger buyer pool. So shifting to a loss, a challenge, tell us about this deal.
So this one, we actually did get it closed, but it was basically a recap in a foreclosure with a lender. So we got it done, but the reason it didn't really trade to the market was it was a great replacement cost story, but the in-place yield was in unit. We're talking about in the threes. And so at some point, buyers are just unwilling to step in and have to cure too much in order to get a good basis. So the basis plays that we're seeing, I remember when I was picking up the phone in 2023, as soon as I said, it's got a great base, and then like the line went blank. Like buyers did not want to hear that they were buying below replacement cost. Like that wasn't a story, they wanted in-place yield. We've shifted now that pretty much every deal I do in the core is negative leverage. People are buying on the 4s and putting debt in the low to mid 5s. So negative leverage is okay, but vastly negative leverage without a clear line of sight to getting to some semblance of cash flow just doesn't play in the market. And again, like I said earlier, that if your building's not operating well right now, no offense, it might be you. The market's returned enough that you just may be doing something wrong, or you just have a huge amount of supply coming in. So in this particular case, they couldn't get the building operating well enough.
Shifting to core private client, MJ had a deal, 22 million. Tell us about that one. Well,
Yeah, so this was a 3-part transaction. The sale of 2 fully depreciated assets with a lot of deferred maintenance, and then exchanging that equity into a $22 million building, 2010s construction, that the family intends to be a legacy asset for the next generation of their family. All 3 of those transactions were done off market, and what were the 2 keys here, the client was really realistic about the value of their 2 down legs. They understood that if they were selling at a perceived discount, they were also exchanging into that same market. So they could make it up on the buy, in theory. And then secondly, they let us go under contract on the 2 down legs prior to having the up leg property even identified or solidified, which can be a nerve-wracking thing to do, obviously. But what that allowed us to do is to go out and shop more aggressively and be taken seriously by the seller of this asset that we ultimately won for them. So yeah, it was a great win in terms of getting them, better returns on equity and into an asset they want to hold long term.
that's great. Yeah, I tell people when they're considering that exchange, they don't know what they're going to buy. Usually from signing a listing agreement to going under contract and closing, it could be around 6 months, plus your 45-day identification period. So if you haven't found anything to buy in that period, you might not be a buyer. Loss, so how could have this one been handled differently to see it over the finish line?
Yeah, so on the surface, this deal looked great, good vintage, good scale, and just a good fit for the buyer. Where it ultimately fell apart was during due diligence. Some trends that were pretty troubling started to emerge in terms of occupancy going the wrong way, rents going the wrong way for several months, that ultimately killed the buyer's leverage, and they just shied away from the deal. So I think the big lesson here, kind of to Dylan's point, was we like to partner with clients early in the process, even if that means delaying going to market or delaying entertaining offers, to really act as a, almost an advisory or asset management type role to help clean up operations if we can, or at least have a really good deal story in place so that when buyers come to the table, they're confident with the full picture and are excited to move forward, and sellers don't leave money on the table and get a successful sale.
Absolutely. Yeah, we've had that happen 3 times this fall. We were excited to bring some properties to market, and although it doesn't help us out in the short term, we just said, hey, you're not in a position, you have too much vacancy, it just cropped up during the BOV process. We got to hold till next spring, get these things operating correctly, maybe push some rents, prove out our story. So some of these things do take more time, but partnering early does help. JD, win down south.
Yeah, I would say the big one with this one was having boots on the ground down in Tacoma. Having Elijah and Tony office out of our Tacoma office and knowing this sub-market was crucial to getting this deal under contract, and also going under contract with no due diligence period. So they knew the private clients down there that were looking to place some money before year end to get some depreciation, and they actually even lived a couple doors down from our ultimate buyer, and they were able to cure a few hurdles we had before ultimately going under contract. So it really came down to the relationships.
Yeah, I heard there might have been some late night drinks to get over some hurdles and get these things signed.
However, you got to get a deal under contract.
So a loss, a challenge, what could we have done differently here?
Yeah, this was to, I guess, the point MJ just made. We have been talking to this owner for probably 6 months prior to going to market, and there was a lot of deferred maintenance at the property. And we talked about upgrading some panels and even doing some side work before going to market because they were going to get penalized ultimately by the buyers if they didn't do the work. And they elected not to, which was fine, and we went to market, and buyers came back, and we actually had it under contract twice, and both times they came back with a pretty big ask that had to do with panels and some other deferred maintenance. And so ultimately it was one that we couldn't get done, and I think it goes back to the point of being able to cure some things early on before going to market can ultimately end with a higher price.
Excellent. And last, Max, you had a win over Eastern Washington.
Yeah, so this was a recent sale of ours. Yakima's not necessarily a market a lot of people are that excited about, but we had someone leaving Kitsap in an exchange, and his daughter actually worked in Sela, right outside Yakima, and he just wanted to be in a great location. This is an A-plus location in Yakima, 2019 building, strong rents, and he bought it at $300,000 a unit, which for Eastern Washington is strong. For Yakima, that's extremely strong. And it just goes to show how important right now, or what buyers really want right now, is just strong location. And they want a building they don't have to go through and gut the electrical and plumbing.
And they like them in the Palm Springs of Washington.
And it was in the Palm Springs, Washington. And then this loss, this was one we actually got under contract last year. It's an older building in Spokane. Great client. We've sold, I think, 10 properties to in the last 3 or 4 years. Got it under contract, but then before feasibility, it fell out of contract because all the rents were just well below market. And we did a rent comp study and to kind of say, hey, I know they're low now, but you can get them up. Here's what the neighboring properties are renting for. But the buyer ultimately said, there's just no proof on the current rental. And so they didn't think they were going to get the returns. This one actually just turned back into a win. This was about 9 months ago, and after filing contract, we worked with that owner to push rents. And while he couldn't get every unit to market, he pushed enough units to show and create a case that, hey, if you can do it on these last 10, you can do it on the next handful of them. So we just got it back under contract at our price and just wait feasibility. So that just goes to show, work with us to really get those rents to market. It really helps get you the highest price.
Max never has any losses.
Fourth quarter comeback. Next slide, I wanted to look at just pricing in general for the last 10 years. So you can see the 0 line is what the listing price was as advertised by CoStar, and the percentage off or above that sales closed. So when people ask about bidding wars and going well above ask, it happened in one moment in time. It was the end of 2020 or 2019. Washington State was passing the excise tax, which is going to be a big burden on the owners, and so there's a lot of aggressive sales and trades at the end of that year. Outside of that, you can see 1/4 of a peak and 1/4 of a trough, but generally within that 2 to 5% band, you're doing really well. So just want to turn it to our team, because this is where the boots on the ground comes in. As I mentioned, call for offers, multiple offers. I'm curious, Dylan, on your last handful of deals, how many offers are you getting, and actually how many are at the top? Are we able to start push pricing yet?
Yeah, so CFO call for offer, that's a technique that sellers love, buyers don't like as much, but it really responds to market cycles. So when you've got good competition, you set a bid date, you collect offers, and you pit the buyers against themselves. As you can see, what happened after the end of, the middle of 2022, it was getting really hard to get buyers to show up. This is when the interest rates, the huge jump in interest rates. And so for the next couple of years, we were hesitant to set call for offer dates. We were taking bids as they came in, and if the right buyer showed up, we would go to our client and say, I think this could be our buyer, let's try to transact with them, versus choosing from a pool of 4 or 5 offers. I'd say 12 months ago, sitting up here, we were starting to set some call for offer dates, but the pool was 1. As you'd call for offers and you'd have 3 groups that were close, you'd have 2 groups that were pretty aggressive and they was far away, 1 group that if you didn't transact with them, pricing was going to fall off at least 3 or 5%. And if you didn't transact with that next tranche, it was going to fall off 8 or 10%. Now we're at the point where the markets have reformed. At that peak pricing, we're having at least 2, if not 4 bids. So the market really is forming, like I mentioned before, price discovery, is we're getting to a point, and most buyers, they have a sense of where the market is, and they're just bidding against the market. They're not bidding against the seller, they're bidding against their competition. And so we're starting to see that competition reform, and you can see that picking up in the data, is we're starting to get back to closer to ask price. And asking prices are getting a little bit more realistic as we're having a little bit more alignment with sellers of where the asset can clear the market.
So it sounds like, I've seen the bid sheets, on some of them had 10 or 12 offers. You're saying 2 to 4 competitive offers, that you're going to best and final?
Yeah, I mean, it's the top of the mark where I remember in 2017, 2019, 2021, you could have 6 or 8 groups. We'd had multiple rounds of best and final. It feels great. It feels like you're a hero. Right now, it really is that last couple buyers at the top.
Yeah. So shifting to Pierce County, how many offers are you seeing across the last few deals?
Yeah, I would say for Pierce County and South Sound, right now, if a property is struggling with delinquency, deferred maintenance, or maybe not a great micro location, we're probably getting anywhere from 3 to 5 bids with really only one at the top. Now, if those things are cured and there's minimal amount of delinquency, minimal amount of deferred, and it's a good micro location, that can get up to 7 to 8, but 2 to 3 at the top.
Yeah. So it's starting to create some competition.
Yeah.
What about you, Max?
Yeah, like I said earlier, we still trail these guys by a couple years, and in this sense, it's probably a couple months. We're still seeing, it's pretty rare for us to do a call for offer. Actually, over in Spokane, Spokane, Eastern Washington, it's just been tough to get groups out of bed to really dive into the materials, underwrite the deal, find a time to come and tour it. A lot of our buyers are from California and Seattle. So in terms of call for offers, we've been a little hesitant to do that. It doesn't look good. You do a call for offer, and 1 or 2 offers come in, but you have other groups interested. They just haven't found the time. But overall, I'd say we're starting to get around 2 to 5 offers, with 2 or 3 of those being serious contenders.
That's good. Good recovery. I don't think he's here, but a client emailed Dylan and I about a month ago and said, "Hey, I'm just putting together a list of what are the most annoying things buyers do." And I'm like, okay, everything. But the one that stands out to me is saying, "We're going to offer, this is our deal," and then just ghosting us on offer date. Makes it a little awkward for us as we try to advise our clients. So I get that you're competing, but if you're not going to offer, just tell us, then we can better strategize on how to get you to offer. MJ, how about you?
Yeah, similar to the rest of the group up here, in the private capital space, on our last 10 listings, we averaged 5 offers per listing, with around 2 to 3 being at the top, most compelling towards the seller. And that, obviously there's ones that stand out if they're priced really competitively, or there's seller financing or a different component that really drives more traffic. But right around 5 offers, and then 2 or 3 being the most competitive.
Yeah, it's a good reminder if you don't own an asset or 2, you're considering selling, maybe you've, like the exchange that MJ mentioned, have no more depreciation. We went from 1 offer on a property to 6 by offering some seller financing. So a way to create more competition if you want to sell at a higher basis, offering some lending is a good option. And then the last one, distress versus drama. We get on the phone often and they just say, "Oh, we'll wait for the distress. We'll wait for banks to start taking properties and selling them." We've worked on a couple of them, which just haven't been as common. So I'm curious, Dylan, when people ask you about distress, are you seeing it? Do you think that's yet to come, or in the rearview mirror? What's your prediction?
Yeah, we just didn't see that many distress sales, and I don't think we're going to see that many. I mean, one I worked on is when we go back to the bank, and shockingly enough, it went back to the bank sold the note for the exact price that our top buyer was at. So the markets are just transparent. I mean, I'd say the distress is really when you've got a forced seller, and it's like JD was saying, there's really bad delinquency, there's a lot of deferred, and it's in a poor micro location. So I think if you're finding something that's distressed, it is distressed, and everyone knows it's distressed, and you're taking on something that's challenging, and you'll probably get paid for it, but there's not a lot of like diamonds in the rough out there. I think this cycle in GFC, people raised these huge distressed funds. They didn't really deploy. I know they're getting deployed in some other markets, but I think, like I was mentioning, the sales side, we're back to a more normalized sale path. And if there's something out there that looks really rough, you might find yourself a good deal, but you're gonna have to work hard for it.
and compete. I think there was a bank sale in Fremont during the pandemic, they had 17 offers. So
Yeah.
pricing got near where it would have, because everyone wants to stress. I just remember we have one more slide, so we'll go backwards in this one. I guess I can't. So Dylan, what are you recommending in your market, and then what's been the behavior recently?
Yeah.
And then what do you think, what's something unpopular you think about the next 5 years? The trend's gonna continue.
Well, I mean, I think it's still a buy market. I mean, most of what we do is, Western Washington, a lot of King County sales. Like, I think it's a dollar cost average market. I think it's a basis buy. I'm from Bay Area. I see what's happened down there. I believe in Seattle. I was the guy that drove through Chop Chaz in July of 2020 and saw a live dumpster fire at 5:30 in the morning in Capitol Hill. Like, truly a live dumpster fire. And I'm still buying on Capitol Hill. You saw my slide, so.
But you moved to Bellevue.
I didn't move to Bellevue. Thanks for that. But I think from I think it's still a time to buy. I think we're picking back up, and I think with buyers have been, they've been very cautious. Like I said, people did not like the basis play or replacement cost story, and the market's definitely picking back up. People are re-entering the market. There's competition in the market, and I think something that is. Jerrid asked, like, what's a trend that may persist? I think we're starting to see issues with rent control. Buyers are looking at value add deals and saying, I don't know about what's happening with rent control, but I've seen it happen in New York. I've seen it happen in the Bay Area. I think this is going to be a strong market, and I think capitalism is going to outweigh some of the economic or the political woes we have.
Thank you. MJ, your recommendation and why?
Yeah, I think it is a great time to buy. I mean, echoing a lot of what Dylan said, but the chart that we referenced earlier, you can buy at a great basis, looking 8 years back, similar price per unit, price per foot, cap rate metrics that you haven't really been able to in 8 years. And then what's strange is when things were peaking, 2019 to 21, capital's flooding in and cap rates are compressing and deals are getting bid up. And now there's no competition, or less competition that's coming back, and so I think it's a great time to go chase deals that we want to own long term at a great basis and compete less. And so we have been seeing a lot of flight to quality as far as trends for renters and investors both, maybe coming back from secondary locations into more core locations and chasing quality assets to try and avoid some of the delinquency that we've been seeing. Then a bit of a contrarian take, but our team sold a lot of early 1900s vintage properties recently, and I think that's a segment to keep your eye on because you can pick those up at such a great basis since they've fallen out of favor with a lot of owners due to insurance costs and CapEx needs, that even when you pencil those in, you can pick them up at a pretty big discount in good locations.
Love it. JD?
Yeah, I think for owners right now in Pierce County, it's a whole period. I mentioned it a handful of times, but they're really getting penalized for having delinquency and deferred maintenance at their properties. So I think if you can come in and you can clean that up and potentially maybe bring in a new manager or whatever you have to do to clean up the delinquency, put in a few dollars on the deferred maintenance, I think you'll get paid for it 12 to 36 months from now. And I think right now what we're seeing a lot of is Tacoma's been hit hard with Measure 1, and a lot of people aren't looking at urban Tacoma, and I think buyers will continue to go even east Pierce County, Frederickson, Puyallup, or south to Thurston County. We've seen a lot of trades in Olympia and Lacey this year.
Thank you. Last, Max?
Yeah, so I touched on this earlier, but I think right now if you're an owner in Eastern Washington that, you had great offers and at the peak and we call you and see what your plans are and say, I'm gonna wait till the next peak, I think you're just gonna be waiting a while. And so if you're serious about selling, now's the time to do it because pricing's just gonna stay pretty stable. It might get a little bit better next year, but it's not gonna make the jumps like Seattle's and San Francisco's are doing. And we are starting to see more buyers just get active in Eastern Washington. There's 7 sales in Q2 this year, which is the least since Q3 of 2013. That jumped to 18 sales last quarter. So with kind of this interest rate drop talk, we're just seeing some of those buyers come out of the woodwork, get more active. So there's not a ton of great deals on the market. And so if you're a willing seller right now, there are good buyers out there, and I just think you're gonna wait, probably 5 or 6 years till we get back to that peak pricing.
This guy never stops, he just wants to keep selling.
Sell. Last slide, Dylan, you mentioned this. This is all about Dylan. So orange is development land sales and blue is existing apartment sales. So in 2016, half of what we sold was development land, and last year, 0%. So sold a couple last year, and I think you're on the market or under contract on 5 land deals now in the last 60 days. What's changed? Like, give us some insight.
Yeah, pent up capital demand. I mean, I mentioned earlier, people saw we were talking about supply dropping off a cliff. So Q4 2024 was peak of deliveries. And so we're coming off of that. I think developers want to build. I think people see there's a shortage of housing. There's a shortage of affordable housing. We build a lot of luxury housing in this market, but it does trickle down of new supply. So I think prescient developers are lining up sites, knowing that if you find raw land today, what I call your capital event, which is either your sale or your refi, is probably 5 to 7 years out from sitting here today to make a money from a piece of land. So developers are forecasting out what it's going to take to get into the market, and they're finally being able to capitalize sites. So we're on the very bleeding edge of it right now, tip of the spear, but we're actually setting call for offer dates, getting bids, moving them along, and that's the first. I mean, we've seen some trickle in last year. We had a waiver on a land deal earlier this year. We've got a few more coming up. So it's just coming back.
Urban, suburban, private, or institutional? Who's leading the charge?
I'd say the easiest one is institutional, just more institutional capital to raise. A lot of friends and family coming on private capital development deals, and they've been doing pretty well in the stock market, and have been a little nervous about investing in Seattle for the private individual to think about being in Seattle in these markets. So I'd say institutional sales or developers are leading it. It has been suburban. If I had a 20-acre garden court site pretty much anywhere in Washington State, I could sell it, but there's not a lot of that land. So I'd say mostly suburban, and if it's not suburban, it's close to the east side. We are on the market with what I believe is just an absolutely terrific podium Seattle site, and we're getting really good traction on it. And I've got several clients working on off-market Seattle podium deals. So it's really starting to happen again.
Excellent. Well, thank you all. Just a reminder who we are, what we're selling, the whole team and where we sell, and then the super whole team. Any questions that anyone has they'd like to ask before everyone gets out and out of here? Yes.
Do any of your clients talk about insurance as being a factor in purchase or sale? We're finding that a lot of providers have been leaving the market. That's even with rates doubling, On top of that, there's companies that don't even provide insurance anymore in Washington State. What are your buyers or sellers talking about?
It's a great question. I think for the first time ever, we have made-up contingency in a sale last year. This is an insurance contingency, right? Something that we used to answer in early due diligence, and now can change as late as right before we close. So a major issue, the number one thing that pops in is going to be old electrical. So as Max mentioned, advising that we get some of these things taken care of before going to market seems to improve it. And I don't know where Jack is, but I think he's closed more sales by introducing people to insurance brokers than anyone else in this room. So really starting to expand what your insurance options are. So we've found some teams actually in the Southwest and the Southeast that are insuring these private, smaller, older buildings, which has made a significant difference in our ability to close sales.
I just got a quote on an older building that the in place was about $275 a door, and the quote was $604 a door, and I was ecstatic. Like, I think that somebody would write on it. So I think what we're doing two things. One, we're underwriting insurance into our underwriting because buyers are going to do the same thing. We want clients to be eyes wide open, and we're trying to source insurance policies. So I think it's just being eyes wide open and being transparent. It's kind of like what resetting taxes a couple of years ago used to be on a sale, is the buyers are going to reset taxes on the sale price. It's real, so it's being eyes wide open. But it's a major issue, and we're out there solving it on the leading edge.
Anyone else?
On rent control, would you guys say you're hearing more complaints about the cap on the rent or the administrative burdens, or is it just the specter of rent control, not really details?
Go ahead.
A lot of uncertainty, right? Seattle's been famous, this is a Washington State thing, but for passing legislation, no way to enforce it, no clarity on how it's going to be enforced. So right now, people are wondering what to do, right? And then the biggest impact, as you're aware, is going to be on the value add deals with below market rent. So anything that was affordable, that people are getting out of the market, it's so hard to manage, essentially forcing them to sell because they don't feel like they can keep up with it. But their biggest impact right now is how to administrate it. It's less so on the economics so far.
Yeah, I'd say it's really hurting value add deals. I mean, normally a value add deal where you're 30% below market rents, a buyer is coming in saying, I'll underwrite 10% growth, but not the other 20%, because I don't know what I'm getting. So it's a little bit of both, the administration of it, just the specter of what does this mean. One of the panaceas of markets is just good rent growth, but if you have good rent growth now, how do you enforce it? I do think this will just be underwritten into pricing in the next couple of years, we'll be back to normal, but there is some shock that we're just seeing right now, just shock in the market a bit.
So you mentioned young people are moving to Bellevue for quality of life, et cetera. So I'm just wondering, do you have any forecasts on the impact of finishing light rail to Federal Way and across Lake Washington? And how the market will respond to that, or whether it's already absorbed those things?
Yeah, it's a great question. I don't have any data on it. I mean, I'd say the best data I have is just anecdotal coming from the Bay Area and watching what happened. They have Bay Area Rapid Transit, the BART lines, and looking at what happened in the Bay Area is it allowed people to live out in Livermore, which is the far east side of the Bay Area, and commute into San Francisco. So when I was first in San Francisco in the late 90s, early 2000s, you could hop on a BART train from Embarcadero, which is basically there downtown, to get to the east side. When I left San Francisco in 07, you would have to get on a BART train going the opposite direction, 3 stops, because there were so many people trying to get on the train, get to a station where you could get on the train going the right direction. So I think it's going to take the next 3, 5, 7 years for this to play out. I think what's happened, why people are moving into Bellevue, and I think the trend is, it's just harder to get to work. And so if someone was living out in North Bend or Issaquah or Sammamish and they're commuting on 90 or 520 from Redmond, they're saying, how do I get to work? What's my lifestyle like? Will I pay an extra $200 a month to wake up where my commute's now 20 minutes, not 45 minutes? So I think that's the near term impact. I don't think we're seeing it just yet. We got to get in that train to be able to get across the bridge. Is another major issue that we haven't solved yet. But I think it's going to be slow, and I think once it takes hold, the impact like the Bay Area was pretty strong. It opened up a lot of neighborhoods outside of the Bay Area. The Bay Area took 30 years to take hold. Here, I think it's going to take hold the next decade.
All right, a lot of people have other plans, so I'm going to wrap it up here. Thank you, everyone, for coming, and grab a development report on your way out.
Thanks, everybody.